well, first of all, I'm Dan McDermott. I'm with Voris, and we're joined today with Basile Senesi from ARC Technologies. And Basile, you joined Kyle a few months ago, right? When you guys, I think, shot a little YouTube video about the whole SVB situation when it was hot and heavy, right in the middle of everything, right?
That's exactly right. Yeah, he picked my brain a little bit through the ups and downs of the regional banking crisis, and we've learned a lot since then. So happy to share it.
Yeah, absolutely. I look forward to getting in there. And anybody in chat, if you have questions, please pop them in. And then we'll also have this posted in the nest for anybody else who's in the Voris community. So yeah, look forward to jumping in. And Basile, why don't I let you take over here? Anybody has questions? I'll be sort of in the background here. I'm not going anywhere. I'll be answering stuff and then also shooting them over to Basile by the end of this presentation. So look forward to it here. And let me go ahead and give you full. All the glory of the full screen here and let you get into it.
Perfect. All righty, I appreciate it. Amazing. So guys, thank you so much for taking some time. I realize this is a dense topic, of course, an interesting topic, but a complex topic. I think what's interesting is that, we've never talked about banking more than we have in the past 3 months. And it's a reflection in a lot of ways of the broader changes that we've all gone through in the macro, culminating into the meltdown that started with SVB and the dominoes that fell since then. So part of my goal today, very simply, is to not necessarily dwell on the past and on what happened, but unpack the fundamentals of how banks work, and more specifically, how you can apply those fundamentals to picking the right bank partner in a way that works for you, right? With that in mind, I want to just maybe give a quick primer and a disclaimer. We play that role. We're a bank. We bank startups, we bank founders. Our main mission in life is to give founders access to 3 things: capital, banking, and payments. What that means, right, is being the recommended place for startups to store their cash, spend their cash, and access additional liquidity as they need to. We bank, several thousand customers, generally VC-backed tier 1 companies, many of them former SVB customers. And we've really seen kind of our growth accelerate in the wake of that crisis because we're purpose-built for this moment. Namely, the bank partners that we trust and rely on under the hood are not at risk in the same way SVB or FRB were, and the digitally native interface that we're built atop of, is much closer to the digital experience that I think most startups want to find in this day and age. We'll get into all of that. I think, beyond what ARC does, who we are, based in SF, again, 1,000 plus startups trust us. We're growing very, very quickly. We've got folks from some of the best and the brightest minds in the Valley and beyond. And ultimately, we've raised, quite a bit of money from some very, very top tier investors to help build that vision. But let's get into the interesting thing. Like, what actually is a bank? People tend to answer this question in very different ways. At its core, it's really 3 things: giving you a place to store your cash, making sure it's safe when you do that; giving you access to liquidity, borrowing, lending, whether credit cards or mortgages or large loans; and then ultimately asset management. Not everything is cash. And so what do you do when it comes to wealth planning, wealth management, investing in stocks, bonds, treasuries, all that good stuff? For someone to be considered a bank, they generally have to be playing in all 3 of these buckets. And so let's talk about the various kinds of banks that exist. We talk about ARC as a bank. In reality, and from a regulatory perspective, we're not, because a traditional bank requires a banking charter to be federally registered. It takes years and years and years to apply. It's very, very competitive, very expensive, and very slow. It also requires that the financial institution designated as a bank be keeping customer money on their balance sheet directly. That when you put a money into Chase, it's sitting somewhere on Chase's balance sheet. And that's not the same as fintechs like Brex, ARC, or Mercury, who are ultimately partnering with banks, but not holding the deposits themselves. We'll unpack that more in a second, but that's the second big piece here. Now, finally, banks earn money in ways that are very similar to fintechs, but tangential. When you store money at the bank earns money on that. I'll unpack exactly how that works in a second, but deposit revenue is, at least in this market, but even in general, the core driver of banking, stable revenue. Of course, what they do with your deposits, they lend them out. And so they're earning interest on the money that you keep in the bank as well. That's another big piece of their revenue source. And of course, fees from asset management, fees from, payments, fees from various transaction types that they support, et cetera. Fintechs look very different. Again, Brex, ARC, and Mercury, BAM, as we like to call it here at ARC, is kind of the trio leading tech banking for businesses. And the core difference is that we're not actually storing these deposits ourselves. We're not federally registered as a bank, and we're not directly earning revenue from the cash being stored on our balance sheet. Instead, we're charging some spread from the partners that we work with and build on top of. I want to unpack a little bit what the infrastructure looks like, because I think that helps paint a picture. And to do that, it's important to start by understanding how banks actually make money. And so we just talked about this a little bit, but like, what does it mean to earn money from deposits? But what happens when you put money in the bank? You have, as a startup, you raise a brilliant $500,000 seed round, and you have to park it in a checking savings account somewhere. When you do that, the bank has a couple of options. Now it has $500,000. It can do nothing with it. It can invest it into securities, into other instruments. It can lend it back to folks, or it can park it at the Federal Reserve. I'll start with that first one because it's the most relevant and interesting one today. There's a program called the Secure Overnight Facility Rate. And SOFR, as it's colloquially known, basically gives banks revenue for money that they keep at the Federal Reserve. Without getting too far into the macroeconomic weeds, the Fed sets the target interest rate. That target interest rate says two things. This is the minimum rate at which you can lend, and this is the rate that you will earn if you keep money at the Fed through SOFR. By raising that rate, the Fed is incentivizing banks to do effectively more of one thing and less of another. It's saying, we'll reward you more for the money that you keep at the Fed. And by the way, we're making lending more expensive, so it's harder then to lend, obviously, by setting this rate higher. In this market, what we've seen over the past year, right, is that means it's now really interesting for banks to not do anything with your money and just give it to the Fed. That's how the Fed pulls money out of the system, cools the economy, brings down inflation, yada, yada, yada. But the benefit to the bank is ultimately that by taking your money and doing nothing with it, in this market today, they can earn nearly 5% interest for just having it sit there through SOFR. Of course, in a different market, in a zero interest rate policy environment like we were in before Q2 of last year and had been for a long time, it made a lot of sense to lend because interest rates were near zero. It was very cheap for companies to borrow, so there was a lot of demand for debt, and banks could charge a decent spread depending on the risk profile, et cetera, on those loans. So instead of parking it at the Fed and earning nothing, they would lend that money out, and there was a lot of cash being lent out as a result. Of course, the final piece, and this is what got SVB to arguably a hot degree in a lot of hot water, they can invest it, buy securities, invest in various, kind of long-term, short-term treasuries, et cetera. Of course, securities carry risk. Even the safest securities, it's not cash, it's not liquid, and they have asset volatility associated with them. But if you're taking that money and you're investing it in certain securities, you can earn a pretty meaningful return. What happened with SVB? They were lending a lot of money. They wanted to offset some of that loan risk with safer revenue. They couldn't park it at the Fed and earn anything because SOFR was effectively at zero. So they bought what was considered to be safe treasuries. Without getting into the weeds on secondaries and all this good stuff with securities, effectively they ended up in a position where those securities were not worth a whole lot, but they were locked up. They had a lot of lending on the books, and they couldn't easily allocate money back to SOFR. That's the gist of how banks make money. Now, why does that matter? And how has that changed over the past year? There's a couple of things to consider. Everyone feels like we're able to now take advantage of rising interest rates by having money at the bank. There's advertisements everywhere for higher APYs, for savings accounts that pay more. Obviously, the Apple Goldman Sachs announcement was a pretty good sign of this. Consumers can now earn 4% on a Goldman Sachs Apple savings account. Well, the reality is that's true, but banks have gotten fatter than consumers have and that their customers have, because the gross earnings that banks get from customer deposits have gone up much faster than the yield payouts that they've given. If you look at the three lines on here, the top dark blue line represents the actual APY that banks earn on average from funds placed through SOFR. Today, we're near 5%. This is, of course, dated by a few months if you look at the x-axis, but the gist of it is, they've seen their revenue from deposits increase very, very quickly. At the same time, the light blue line is the average yield payout on savings accounts that a whole basket of banks, when averaged together, have been offering their customers. Again, average means that JP Morgan Chase, they're still hovering in the very low sub 1% range. Other banks have gone up higher, above 1, closer to 2. But when you're earning 2% on a savings account, that doesn't mean that you're actually earning the bulk of that interest rate increase that we've seen. So if you look at the net earnings that banks have taken advantage of, they've gotten much, much, much fatter, even though they're making their consumers a little bit wealthier in the process too. The good news is that not all banks are treating this spread the same way. And so if you know what good looks like, you can take advantage of that. Now, the flip side of this, earning more because interest rates are high is important. But how do you actually also avoid the downside scenario we faced with the regional banking crisis that involved First Republic, that involved Silicon Valley Bank recently? Well, there was a lot of talk around cash protection. And so beyond making sure that the money is earning interest, it's important to make sure the money is also safe. How do you make money safe? There's a bunch of different ways you can do it. 2 things: structural insurance programs, and then the perceived resilience of the bank that is holding these funds. I'll start with the second one because that's easy. The gist of it is some banks are considered too big to fail, more formally known as systemically important or strategically important banks, SIBs. These banks are widely seen as no matter what happens, we're not going to let them go under because that would crater the economy. Money at Chase, considered too big to fail, means that even if your funds are not FDIC insured, if Chase were to go down, probably the federal government would step in and make sure that we're in an okay place. That's a lot of wishing and prayer. But in the pecking order of banks that might fail in an absolute catastrophic scenario, that's where SIBs come in. That said, that's not enough. Insurance programs help drive actual true safety in a formal papered way. And there's 2 kinds of insurance that exist: FDIC, the Federal Deposit Insurance Regime, and SIPC, the Securities Insurance Program. FDIC governs checking accounts and savings accounts. SIPC governs brokerage accounts and generally all invested assets. Starting with the FDIC piece, it's a government agency. Banks pay a portion of their revenue into FDIC every year as part of their insurance premium. And then if the financial institution that is FDIC insured fails, deposits from their customers will be covered up to $250,000 per depositor. Now, the important thing to keep in mind, per depositor, per insured bank, if you have your cash at the same bank through multiple different fintech partners, for example, which again is how fintechs are built, you're insured once, not twice. And so it's very, very important to understand actually where the cash is sitting under the hood. We'll come back to that, but keep that one in mind because that's been a very big topic of conversation lately. Not every bank that is federally registered is FDIC insured, so reading the disclaimers for FDIC insured, member FDIC is key. SIPC, same concept, private, covers more, technically up to $500,000, but a pretty big distinction. This is coverage in the event that the brokerage fails. It is not coverage for loss of asset value. So if your invested securities go to zero, but Vanguard or BlackRock or whatever still exists, you're not going to get money back for that. But if they fail outright, you will be reimbursed up to $500,000 out of this insurance program. That's great in theory, but $250,000 plus $500,000 is not generally enough to cover most corporate assets that venture-backed startups have. The venture model generally is you raise a pile of money, you burn through it, you raise another one, you burn through that. The amounts that are involved in that generally far exceed the deposit insurance limits. And so companies have to come up with different ways to solve that. Of course, one way to do it is to allocate cash across different banks. But a more common and traditional way to do it, and it's what large corporates typically do, is to hold a different kind of asset that effectively is insurance on its own. The US Treasury bill is widely seen as the safest type of asset that a company or a person can hold. Historically, they have not been a very high yielding product. They haven't given you a lot of returns. They haven't been very interesting, frankly, but they've been very safe. Because of the interest rate environment we're in, that's no longer true. Those assets are now both some of the highest yielding considered safe products, while also theoretically being one of the safest. What's a T-bill? It's an IOU to the federal government. When I buy a T-bill, I'm basically lending the US government, the US Treasury Department, a certain amount of money, and they are promising to repay me that amount of money plus interest, what's called a coupon, at a certain date in the future. The further out the date in the future, the more I generally expect to get rewarded for that. And I can buy different lengths of Treasury bills as a result, a 1 month, a 3 month, a 6 month, a 12 month, a 10 year. I expect some payout for that. Basically, it's a guaranteed payout, a guaranteed interest rate from the safest, most reliable payer out there. The US government is seen as safer than JP Morgan Chase, for example, and it will always make good on its debt obligations. So holding a Treasury bill is considered a great way to insure cash above the FDIC and SIPC limits. Secondary benefit these days happens to also be the highest yielding product on the market, kind of in the safe category. The other part of this, however, is maximizing FDIC insurance. So what you saw in the wake of SVB is a lot of CFOs started to open bank accounts in a bunch of different places with the intention of kind of chunking out their cash that had all been in one place across a bunch of different places. And the goal, of course, was to maximize FDIC coverage. Well, that's great in theory, and it works. Of course, the reality is you have an account at Chase, at JP Morgan, or at Bank of America and at Wells Fargo. Now you're insured 3 times. Awesome. Chunk it out into 3, equal amounts at each bank, and theoretically you can get to the coverage limits that you're looking for. The problem is, having cash in a bunch of different places is inherently painful, especially when you're a business that's going through a lot of that cash. When you're moving money from bank to bank, generally wires take a day and cost money. ACH takes 3 days. The money's not in either account while it's in transit. There's a whole bunch of limitations that just make managing multiple bank partners very complex. And so while in theory you can have as many banks as you want to maximize your coverage, in practice, it's prohibitively complex and opaque and slow. That's why cash sweep networks have emerged as a very common way to do this, where effectively your money goes into a cash sweep account. Under the hood, the bank partners with a bunch of other banks to distribute your cash into different chunks at each one of these partner banks. That way, to you, in your bank account, it looks like one big number, and you can access that number in effectively, one day in your real time. But under the hood, the funds are chunked out across a bunch of different bank balance sheets so that you're maximizing your FDIC coverage. For us at ARC, right, through our product, we have this option. We insure up to $5.5 million through this method, and it involves 30 different banks that are participating in the program. Ultimately, I forgot to slip to the slide, but the end game, very simply, is that with a single kind of account and ultimately a single platform or dashboard or what have you, you can get a lot more FDIC coverage. The added benefit, by the way, is that, because of where yields sit today, you can ultimately get higher yield rates as well while also benefiting from this extra protection. So I want to talk a little bit about how we solve that. And when I say we, I don't mean ARC, but I mean fintechs. This is our dashboard, but I think Brex, ARC, and Mercury generally have a similar way of thinking about building these products. I said it a bunch of times, we're not a bank. We partner with them. What that means, right, is under the hood at ARC, for example, we have 3 different bank partners that we give our customers the option to move money at. But they only interact with ARC in a single dashboard, in a single way. To them, they don't have 3 accounts. They have 1 ARC account, and they can do what they will with the money in that account. Under the hood, though, we manage the complexity of multiple bank partners. The way that we do that is through a middle layer called banking as a service. If I want to start my fintech tomorrow and start storing customer deposits at a partner bank of some sort, well, that takes a lot of heavy lifting. I have to negotiate a contract with the bank. I have to build integrations and APIs and Rails with that bank. And ultimately, that's just a very, very challenging and complex operation, which is why companies like Stripe, like Unit, like Treasury Prime have pioneered this concept of banking as a service. What that means is a company like Unit will go out and find banks negotiate commercial agreements with them, build APIs and Rails with them, and then let new companies build on top of that technology and pay unit a SaaS fee effectively for using that service. It has made it really easy for new startups to access the bank side of the equation and build bank-like products for their customers. And so you've seen a proliferation in fintechs offering services like this, in large part thanks to this middle layer, the Stripes of the world. So when you put it all together, a great analogy to think about this, right, is take the rideshare model. Let's take Uber. The fintech is the app, the banking as a service provider is the iPhone, and the partner bank is the actual car and driver under the hood. The fintech doesn't own your phone. It just pays to be a usable application on that device. And at the same time, neither the fintech nor the phone own the driver. Like, they're an independent contractor, they're doing their own thing. They're using the app and the phone to find would-be riders. Very similar concept. Fintech, front end, app, banking as a service, middle layer hardware, partner banks, actual end service provider that you technically interact with, but don't think about in that way. You don't think about Jerry who drove you in his Toyota. You think, I used Uber. Ultimately, to get the most out of banks today, there's a couple of things to consider. If you're thinking about how do I manage my company's cash in this particular market, what I typically recommend is focusing on 3 core things. Make sure that you have a few different bank partners under the hood and that your cash is diversified across those bank partners. Make sure one of those partners is in the too big to fail category. What people love about them is the safety. What they generally hate is that safety means that the product offering is limited, and the UI, the experience, the service generally also is. But again, safety is one key vector here. And so having a portion of cash there is important. Have, for your day-to-day banking, the actual easy to use, elegant to integrate, and just responsive solution generally offered through a fintech. Separate day-to-day cash from excess cash and invest that excess cash in one of a few different things. A portion of it into highly insured cash sweeps that are very liquid, so that you're making sure that your money's safe, but also invest a portion of that money you're not going to need tomorrow into long-term fixed rate assets that are going to provide guaranteed returns. Treasury bills are generally the most common way to do that, especially in this macro. Finally, make sure that your net APY is comparable, is shopped equivalent to the gross APY. And I'm sorry, there's a typo here. You'll often see APY, the average percentage yield, advertised as a gross number. Banks take a cut from that. And so you might think you're earning 5%, but if the bank takes a whole percentage point, you're actually earning 4%. Don't shop headline, shop net. Finally, if you're going to use a fintech, make sure you ask and you find out where the money's being actually stored under the hood. Because again, Arc, Brex, and Mercury, we're not the bank. We partner with them. Which banks we partner with matters. And if in March you had heard that, let's say Mercury was using SVB, they weren't, but as an example, that might have made people think twice about using Mercury. Well, the reality is those regional banks that power a lot of the fintech ecosystem matter. For us at Arc, we have a diverse mix of banks that we use. Yes, regional banks, but also BNY Mellon, also Goldman Sachs, also much larger financial institutions that we believe represent the kind of trust that customers are looking for in this market. And so knowing who you're actually getting into bed with by working through a fintech is very, very important. With that in mind, right, anyone who is in the market for this, we're very happy to support our Voris-aligned customers. And so we've got a great product. We've got some of the best rates in the market. We've obviously got some of the best protection in the market as well. Not to mention, a whole bunch of cashola for folks that sign up off of this link, if that's ever relevant and interesting. On that note, I'm going to pause there and turn it back to you guys, and happy to take any questions.
Yeah, thanks so much, Basil. That's really that was really interesting. I mean, for me, it's super eye-opening because it's a world I really don't know technically, and I feel like there's so much in there to unpack, especially that final slide that you had, or a penultimate slide, I guess, where just talking about the strategy of how do you actually use the pros and cons of the different types of banks, the different types of institutions that are out there. I have a couple of questions here. I don't see anything coming in through chat, so let me jump into my own questions if you don't mind for a second
Sure.
here. Let's say that I was a founder or a CFO at a new startup, like you said, that had just just raised, let's say, $1 million or something like that, relatively small. I don't really know the world that well, but I'm looking to learn more. What sort of resources are there out there for me to go educate myself?
Yeah, it's a good question. And I think you hit on a very good problem, by the way, which is that most early entrepreneurs are not CFOs. They don't do this by trade, but they have to play that role until they're able to bring on that person, right? So there's a lot of education required and a lot of complexity, especially now. I mean, I think, look, some good resources, of course, some self-promotion here, but I think we have a pretty solid content library that's available. We take, kind of education first approach to thinking about our business. And so if you go to Art's resource guide, there's an entire encyclopedia on key terms, do's and don'ts, ways to think about this that are fairly impartial. So that's a good place to look. I think generally, for my part, I'm not a banking expert. I didn't study this stuff in school. I'm learning it on the fly because it's the work that we do here at Art. And I found that there's some very good voices on social that I like to follow and learn from. Spend more time on Twitter than I like to admit, and that's where a lot of the deep intel on how that stuff works comes from. Specifically, a lot of VCs that play in fintech have done a great job, I think, educating the market there. So I would also look there. I'm on Twitter if you guys want to follow me. Plenty of folks that I am happy to recommend there as well.
Yeah, also, I'll link to your resource library as well here at some point when we publish this. But then also, the idea that you have these experts running around on Twitter, I'm sure a few on LinkedIn here and there, maybe. But yeah, VC Twitter is definitely a thing. I think that's definitely really, really. It's funny how people learn and where some really, really valuable voices are sort of hiding in plain sight, so to speak. So I think that's great advice. I'd really like to see some more there. So I'm going to dig into this later today as well. But I guess I also have a question around, it's been a wild couple of years, really. I mean, all the drama earlier this year with SVB and First Republic and all the, that stuff. But then if you just rewind back into the crypto spike, let's call it, of 2021, am I right? Where, it's a huge rush of money into the market, huge, everything. And then suddenly the crash, I'm not sure if we're still in a recession, but we've seen so much up and down recently. Even with COVID as well. I mean, it's been so strange and so different in terms of the financial landscape and sort of in terms of stability. Do you see anything coming up in the next couple of years that might affect how people should protect their money, how people should use their money, aside from, let's say, diversifying across, as you gave that really great split between the what's called the SIPs and then the fintechs and whatnot. Anything that would change that at all coming up?
Yeah, I mean, it's a very good question. I think, look, yes and no. I think the principles apply through, kind of good and bad. And so good banking strategy is not interesting or sexy in good markets and is only something that people talk about in markets like this one, following crises like the last one we had. But the principles are consistent and are the same, right? The one very small nuance that I would add is there's a bunch of regulatory work being done in DC and across the country around the relationship between banks and fintechs. And that regulation seems really in the weeds, but actually matters. It all centers around who's liable in case something goes wrong. And very emphatically, I think where regulators are coming out is ultimately it's the bank's fault and the bank's responsibility to make sure that who they allow to open accounts and store money with them are the right people. And ultimately, the buck stops with the bank, right? Which means in turn that banks who have effectively sold their charters through fintechs are starting to be very cautious around who they do and don't allow to have accounts open with them. Expect more stringent rules around how banks work with fintechs, around what fintech requirements are when they onboard customers to clear certain hurdles that the banks are putting in front of them. To me, what that means, right, is if we take the FTX meltdown, for example, it put a lot of pressure on their sponsor bank. The sponsor bank didn't actually do anything wrong in this case, but what it meant was, did they do enough work to make sure that the folks FTX was allowing to open accounts were the right actors, were safe, et cetera? And generally the answer has been like sort of, but probably not enough. And ultimately they should have done more. I actually really care now when I look at a banking as a service provider, how strong their safeguards are, how strong their compliance programs are, how strong their onboarding KYC and KYB type programs are, because it's I think a bellwether for how well they're going to endure the regulatory pressure that's coming. So I would probably say that on the fintech side, know the banking as a service provider, know their reputation. That will go a long way towards understanding the likelihood of the associated fintechs doing well or not well in a regulatory crackdown, which we all expect will come in the next couple of years.
Yeah, that's fascinating, and I think it's so important. It's really everything for a lot of startups. I mean, it can be literally life or death. I think that that's not over dramatizing it at all. I suppose this is maybe a little bit of a fluffy question, but I'm curious. Are there any red flags that you would sort of point out? And maybe this is an impossible thing to answer, but let me know. But if there are any red flags at a bank when, again, let's say that I was the founder or whoever looking to sort of analyze the different options that I have, is there anything that I should really look out for that maybe is a big warning to me?
Yeah. So look, I think the short answer is SAFE is generally more conservative when it comes to statements, messaging, promises, etc. If you think about banking, because it's highly regulated, it has decades, if not centuries, of that regulation kind of imposed upon it. It's generally full of footnotes, disclaimers, and a lot of just kind of CYA type language, right? To make sure that no one's saying the wrong thing, because the consequences, rightfully, are dire. I think where a lot of fintechs in particular have tried to step in is exploit that, and to be the bull in a china shop, move fast, break stuff entrant into an otherwise regulated, pretty conservative and muted market. And that means big promises, big claims, really high rates, really fast turnaround times, the most amount of FDIC protection you could ever think of. That's not bad in itself, but I think in aggregate, the reputation of the fintech that you work with should be one that, in my view, is much more aligned with that of traditional banks, meaning safe, conservative, and not someone that's making outlandish claims, that's really trying to upset the apple cart, but instead somebody that you can trust, somebody that you can be sure will be there in a crisis, and somebody that regulators will not look to as the problem child in a down market when we're looking for scapegoats, right? So generally, like if the website says things that seem too good to be true, I like to stay away because it doesn't inspire the confidence I'm looking for. I think that's probably the biggest thing I would call out.
Yeah, that's a great answer. That's a great answer. I think that's very much something that I know exactly what you mean by outlandish claims and stuff. I've seen them, left and right. I also used to work in a different region of the world, and let's say that came up quite a bit. And yeah, it's something to clearly avoid. Okay, well, that's really great. I learned a lot. This was really eye opening for me. So thank you, Vasil. I really appreciate it. And we're gonna get this all published up. But in the meantime, could you let us know where to find out more about yourself, more about ARC?
Yeah, absolutely. I unfortunately spend way too much time, like I said, on LinkedIn and Twitter. So you're more than welcome to reach out to me there. And if you're sharing the deck after this, I think the social handles are on the final page. You can always email me. My email is also on there. I'm more than happy to chat about ARC, about banking in general. I happen to run a winery too. So if you're so inclined and want to talk about that, I'll gladly indulge you. But yeah, feel free to reach out, and I'm happy to be a resource.
Awesome. Well, thank you so much for joining us today. I really, really appreciate your time, and look forward to speaking more in the future. All right.
So take care, everybody. I appreciate it.
Yeah, absolutely. We'll be in touch soon, and everybody who joined, you'll get a recording of this, and we'll speak soon. Take care, everybody. See you later.